All right, so mark to market. Now, let's go a little bit deeper. It's basically to make the proper account adjustments and revalue your trades and portfolio. A mark to market is basically done every evening or at a set time that is pre agreed. So that basically prevents anything being incorrectly valued. Now, if you kind of look back to the housing crisis, you had these mortgage books. When they were marked to market based on the valuation of the property, all of a sudden you realised that things were in trouble, and that's kind of what caused the kind of meltdown, or one of the things that helped kick things off into a bit of a catastrophe. Suddenly, people thought, well, actually, I've been putting these down as worth 20 million, when really, when we look at the book, well, this thing's only worth 10, and multiply that by how many tranches of orders we've got, or tranches of portfolio we've got. That kind of makes a lot of difference. So the mark to market is just revaluing your portfolio, revaluing your trade based on the closing price of the trade, or if you're in a currency, a specific time of day will be time stamped, and normally 10 p.m. a UK time. And then we revalue, and it'll say, okay, well, the value of your position now is X, so we're going to credit or we're going to debit your account, or we're going to require more margin for you to hold the position if it's in a negative balance, or we're going to give you more, or we're going to give you the money, the difference, if it's in a positive balance. So, it works in your favour, really, and keeps you fully aware of what's going on. I mean, unlike a stock, for example, you buy £10,000 worth of stock and it goes down, nothing really happens. Just because you own the stock, the value of that stock, if you wanted to sell it, just becomes what the value is at the closing price. So it doesn't affect anything else. But CFDs, it's slightly different, of course, because you're trading on margin. So there's a lot more sort of complexity to it, to revaluate accurately what the whole value of your portfolio is. And it's going to give you a cash holding adjustment, or a variation margin adjustment, depending on how you want to look at it. You've either got the cash or you've got less margins put up, depending on how you kind of frame it in your own mind. So what's the positives and negatives of margin, cash and margin? Now, positives obviously are you can trade larger amounts. If you've only got £10,000 in your account, you can trade £100,000 position, £200,000 position, whatever it may be. Which gives you more leverage. If that then moves 10%, you've kind of got a lot more from your initial exposure, if you like. Not necessarily exposure, but in other words, deposits. You put a 1% margin up and the thing moved 1%, you've doubled your money effectively. So that's the ultimate advantage with it. You leverage your gains, using other people's money to make more money. And it just makes things a lot quicker if you're on the right side of the market. However, of course, all these things, there's a flip side. The negatives are you can lose a lot very quickly. If you're over leveraged up, if you're really going aggressive, and you're really maximizing out, you're going in with volatile things, you're putting up low margin, you can lose a lot quickly. You can lose all your deposit. And the big thing, which we've really got to be aware of, guys, when we're trading, is that we can lose more than we have in our account. If you've got 1% margin and you're in a stock, for example, the stock wouldn't be 1%, but just go with it for this example, and the thing gaps down the next day by 2%, you've lost your 1% margin, and you then owe your broker that extra 1%. So that is the danger. You can potentially lose more than you have in your account, and there have been instances as well with currencies where we have had situations where they've gapped aggressively, and people who have not put a lot of margin up because they've not expected to, the broker's not expected it to happen, have had to fork out an awful lot of money. So I'm being very, very cautious about that, and understanding that is the kind of pros and cons of trading on margin. So what happens when you do run out of margin? Well, you get what's called a margin call. Now, it's called a margin call because in the old days your telephone would ring, and it would ring and say, hey, do you know what, you need to pay me some money. Nowadays it's an email, automated email normally, and it says, hey, Mr. Trader, Mrs. Trader, you have run out of funds. You need to deposit more funds to cover this position. You do not have adequate funds to cover the exposure on this position. And you need to give that immediate attention. And I mean immediate attention, because if you do not, then certain consequences are going to happen. Now, what are your choices here? You either go, okay, I'm going to give you more funds, and you deposit more funds from your bank account to your broker, or you go into your account and you close the position, or you reduce the position size, or you close other positions to free up some margin. If you don't do that, what will happen is your broker will liquidate some or all of your positions at his discretion. So in other words, he can go in and he can say, you know what, I'm going to close this position. It could be your best position that you've got that you don't want to close. It could be your worst position you've got. It could be the position that's causing the problems. He could close the whole lot. He could close some of it. You know, they've all got different approaches and different ways that they will do that. Again, that's going to be in their terms and conditions. You have to have a look and see what order they do things. But they're not going to do things based on, they're going to ask you first, because they're protecting themselves. Because ultimately, when you start to go into that area of, you know, a margin call situation where you require margin on this, then they're very close to being on the hook for the loss, because it's now eating into that into that minimum margin. If it goes more, there's kind of your buffer gone, and then I've got to put the money up for the loss. So they're not going to do that. They're just going to cut the cord and leave you whatever you happen to be. So the main thing is just always understanding that you've got adequate funds and understand the risk of the trade. So where could the trade go against me if I'm wrong? What could happen? Where could it go? What could it be valued at? Make sure I've got enough funds in it. And generally speaking, guys, you should never have a margin call, because you should always be trading within your risk parameters. You should always be putting in the right amount into your account that's going to cover the kind of risk that you want to take. You should always be trading the position size that matches your account size and matches your risk tolerance. You know, a margin call is generally it's a bad sign. It means you're not really managing risk very well. You kind of not got the right funds in there. You're not planning the trade well enough. It's generally a bad position to be in. So you try and avoid that if you can. A bit of pre-planning and a bit of preparation and kind of getting your funds in the right place and getting the right position size and all those things that we just talked about will stop you getting a margin call. But if you do get one, deal with it straight away, preferably yourself. Get on there, cut the position, trim the position, do something with it. Don't just bury your head in the sand, because the broker may just do anything he wants, and they may leave you in a situation you don't want to be in.